In a recent note from Nomura's bearish quant Masanari Takada, he sees that the trend in U.S. stock market sentiment is starting to resemble the pattern observed around June of 2008 in the run-up to the Lehman crisis. He explains that we see numerous points of similarity between the trend in sentiment now and that before the Lehman collapse in terms of both the extent of deterioration in sentiment and the timing. So let's take a look. According to Takada, if one goes by the pattern in sentiment, he sees the possibility of a vicious bear squeeze rally in U.S. stocks from mid-June through early August, one which may have started 2 weeks early thanks to this week's tremendous ramp higher in stocks. However, this squeeze could be followed by a massive sell-off in mid-August through early September. A few caveats are that this is not his main forecast scenario, at least for now, and he believes circumstances may change based on actions by the Fed. Takata is looking at this chart here and observing the Institute for Supply Management Manufacturing Index compared with the net position on S&P 500 futures by the Commodity Trading Advisors or the CTAs, and it shows a potential net short position similar to 2008. Something to keep in mind when you observe daily market action is that the market climbs a wall of worry, which means that the market will march upward in steps, maybe 2 steps upward and 1 step back. The market does not normally move in relatively large 2% moves on the way up as we have seen this week. It generally moves up 2% in a day when there is volatility in the market, and that is a sign of fear. And moving to other similar good news is this chart from Bloomberg. According to Bloomberg, the bear case for U.S. stocks is getting more compelling by the day. Bloomberg states that there has been a remarkable decline in the macro environment, yet U.S. equities have gained in value in the face of that decline. As this chart indicates, the divergence is unsustainable, but it's a reminder that bear markets take many months to play out. The chart shows the value of global stock markets compared with the global composite PMI, which is the composite of the global manufacturing and services sector. This is a non-opinion monthly survey of over 16,000 purchasing executives from 32 of the world's top economies, including the US, Japan, Germany, France, and China, which together account for 85% of global GDP. Reportedly, this disconnect is one of the widest on record, so we definitely need to keep this in mind as well. Reading the recent news and hearing the pundits talk about the U.S. and China trade talks, it should be very clear to everyone, even the most optimistic, that any deal between the U.S. and China is going to be very difficult to achieve and is not likely imminent. As such, we can observe that economists are starting to reduce their growth projections, but there's a great amount of market damage still to be considered. Based on the market action, most investors remain in denial. It is very likely that market strategists will further reduce earnings expectations, rendering stocks more overvalued and more expensive. By my count, we are in a trade dispute with China, which is one of the largest economies in the world. Now, Trump seems determined to pick a fight with Mexico, which is our second largest trading partner. These two disputes have the potential to significantly damage U.S. companies. Just by jawboning the idea may have caused some damage by creating uncertainty in the market. However, you may not have heard that there is another potential negative in the market because the U.S. will be removing tariff exemptions on India, which is the world's fifth largest economy. My thoughts on this is that Trump is going head on with these other world economies since he may believe that if things in the economy are significantly impacted, the Fed will likely reduce rates to boost the domestic economy. And on that note, one of the reasons stock prices are higher is that the market may now be pricing even more rate easing, with 2-year yields trading more than 60 basis points below the policy rate. This is the largest discount since March 2008, but will make it even harder for the Fed to dovishly surprise the market should risk aversion intensify later in the year. So we continue the path of the stock market. And for today, that's ChewDog Charts. Thank you.